Financial markets have been very volatile over the last few days after the Bureau of Labor Statistics released some new data about job growth, economy, and unemployment in the U.S. And if you're an investor, whether that's real estate, stock market, or crypto, this video is for you. We're going to break down key data that was in this report, how it's going to impact the Federal Reserve and Jerome Powell, and key dates moving forward that you need to be aware of as an investor. And like I said, it doesn't matter what markets you're invested in, it's going to have direct impacts on everyone. So recently, Bureau of Labor Statistics rolled out the February 2023 jobs report. And in this report, there were a few pieces of data, some good, some bad, and you need to be aware of this. The first thing is going to be, which is not so great. The not great news is that non-farm payrolls rose by 311,000 jobs for the month of February, compared to 225,000, which was expected. The bad news here is that this was much higher than expected. Like I said, 311,000 versus 225,000. Ideally, the Federal Reserve wants to see these numbers lower after they've raised interest rates tremendously. They want to see that what they've been doing to combat inflation has had an impact on the economy. And with that number being so much higher than estimates, that's not really a great sign. The good news on this is that we did actually see the number drop substantially from January of 2023, which was at 504,000. So we saw the drop from 504,000 down to 311,000, but still it was much higher than expectations. So take that for what it is. I would say more so on the negative side, because ideally you'd want to see it come in at or even below these expectations, considering everything the Federal Reserve has done to combat inflation. The next piece of data is actually quite good. Now let's switch gears a bit and talk about our long-term channel partner, Qmall. So as I've mentioned in previous videos, Qmall is a legal and EU licensed Ukrainian crypto exchange that is available via its mobile app and on desktop. Its token has increased in value more than 40x since it launched just a short while ago. And recently they've rolled out a few major updates that we need to talk about, and I've been taking advantage of these, so I want to share them with you. So the first one is that Qmall has recently launched its P2P service on its web version, so now you can easily buy and sell crypto directly with other users. Currently, it's available with USDT, BTC, ETH, and Qmall, but they have plans of rolling out more cryptos very soon, so that'll be very exciting. And in addition to this, with the P2P service, there is support and dispute resolution available for 72 hours after a transaction takes place, which you don't really see on any other exchange. The second is that there's zero tolerance policy for cheaters, and anyone who violates their policies can result in an instant ban. And the third thing is that only verified users can use this service. So you can see that security is the number one priority, which is crucial in my opinion. So some people would say that might be a little bit harsh, but I think it's very, very important. And the second major update is that Qmall also recently opened a new section of their application, of their exchange, called Cash, where it will be able to buy and sell crypto for cash directly. And this is due to Qmall having successfully integrated verified exchange services in Dubai and Kyiv, Ukraine. On top of all this, Qmall is always looking at creating new partnerships, rolling out new features, new capabilities, like how they recently just added new currencies like UAH, EUR, PLN, TENGE, and AED. These are all different currencies on different countries. So definitely worth checking out this exchange. I've been using it quite a bit, so use the link in the description and take advantage of these new features. But continuing on, next thing I want to go over is that the unemployment rate. The unemployment rate rose to 3.6% versus 3.4% expected. Why this is good is, like I said earlier, Federal Reserve has been doing everything to combat inflation. They've actually been raising interest rates, wanting companies to not be growing as fast, wanting companies ultimately to have to lay off some employees. And with this unemployment rate higher at 3.6%, that is a good sign. The one caveat is the reason this unemployment rate is higher is because more people are getting back into the labor market. When you're looking at this, it says labor force participation rate increased to 62.5%, which is the highest we have seen since March of 2020. So on the surface, that increase in unemployment rate looked good. It looks like everything the Federal Reserve has been doing has been working, but the reality is that it's simply because more people have gotten back into the market, more people have wanted to participate in the labor market, and that has driven that unemployment rate up slightly. The third third piece of data is probably the best in terms of overall market and for investors. And that is that on the inflation side, average hourly earnings rose 4.6% from a year ago, which was below the estimate of 4.8%. This monthly increase of 0.2% was below that estimate of 0.4%. And the reason why this is good is that it does show us that companies are not just having these rapid increases in wages that they were having before. They simply can't sustain them. And that is a good sign because the Federal Reserve wants to see that come back down. They want to see that more like around that 2% rate. But this is something that is good. They want to see that average hourly earnings be more around 2%. So seeing that it was below the estimate, that's a good sign. Speaking of how this is going to do for the Federal Reserve, how it's going to impact Jerome Powell and their decisions moving forward, there are a few key things you need to know. First of which is that there's going to be one more important report coming out for CPI data. This is key inflation data, and that's coming out on March 14th, next week. The thing here is that this is going to directly impact what Jerome Powell and the Federal Reserve are going to be doing to combat inflation. So we had all this labor data come out. A lot of it was not great for markets. A lot of it is signaling that the Federal Reserve is going to need to do more to combat inflation. But moving forward, we have that March 14th date. That is going to be the absolute key date, which is going to say, is Jerome Powell going to raise interest rates at a faster pace than they originally said? He had said previously that he is open to doing this and that they will do this if the data shows it is necessary, but March 14th is going to be the absolute deciding date as to whether or not they're going to raise interest rates at a much faster pace. Jerome Powell came out on earlier in the week at a Senate Banking Committee, Senate Financing Committee, and during this congressional hearing, he said that if the totality of the data were to indicate the faster tightening is warranted, we would be prepared to increase the pace of rate hikes. So, like he said, if that means they need to do a 50 basis point rate hike, if they need to increase, 50 basis points for multiple meetings in a row, if they simply need to do 25 basis point rate hikes, it doesn't matter. He is prepared and willing to raise interest rates at a faster pace and to a higher rate than they initially said they would based on the data. So if that were to happen, that would have dramatic negative impacts on the market. So like I said, we've had a lot of data come out that shows that they probably will have to hike up rates, but that key deciding date is going to be March 14th, 2023, next week when we have CPI data. So just a little bit of insight into that jobs report, a little bit of insight as to what it could do for Jerome Powell and the Federal Reserve. And like I said, this would probably have negative impacts on the market if we see inflation data come in at any sort of higher rate than expectations. If it's even at expectations, I'm still expecting the Federal Reserve to tighten a bit faster. The only way we would see a pop, a good response in the market, would be if the CPI data comes in much, much lower.